pace at which we're also able to create new products, new capabilities, new research, websites, even software solutions bundled with AI without the technical knowledge of actually doing the coding is incredible. ESG is not going anywhere per se, but people are rebranding. Rather than talking about ESG and sustainability, people talk about supply chain management and compliance-driven measures or ROI, almost from a procurement point of view. I'm not gonna lie when I say that most people are probably scared of private credit for good and bad reasons, but we're starting to see some exciting opportunities.
This is the Assetizer Podcast.
Hi, everybody, and welcome. My name is Tom Lyons, and this is the Assetizer Podcast. And today I'm joined by Erik Wiesner-Mostenicky, who is a principal in Fidelity's venture capital team. And Erik is here because he appeared at our Asset Rush event in May, and he gave a fascinating presentation on a whole wide variety of topics, including fintech, AI, stablecoins, private credit, and the poor guy had to do it all in 5 minutes. So I thought it might be nice to invite him onto the show and give him a little bit more time to get into those topics. First of all, Erik, welcome to the Assetizer.
Thank you very much, Tom. Appreciate the intro, and it's very nice of you. Look forward to the discussion, and yeah, there's probably quite a bit more that we can do in more than 5 minutes on a separate topic. But let's try and deep dive in a few of those that we've got outlined as part of Asset Rush.
Absolutely, and then we can also talk about anything else you like, because we do have. There's no bell like at Asset Rush, so we can keep going. First of all, why don't you tell us all a bit about yourself, your background, and what got you here today?
Sure. So let's start off with saying effectively 7 years ago, we started the effort at Fidelity to build out the venture capital arm. And the focus is on fintech investment with a specific mandate for wealth, asset management, capital markets, as well as the enterprise software layers that touch this universe. We deployed $260 million. We've got an active portfolio of 22 portfolio companies, and the sweet spot tends to be companies around the kind of the Series B stage maturity, where we bring in early growth capital and then through an active board engagement, get into growth and scale. I, for all my sins, have been a banker, a founder, and a strategy consultant. So take the Venn diagram of VC in that respect. But have been in fintech for longer than a decade. And that has helped formalize a lot of the thematic investment research that we compile that is quite core to the way we do investments.
Great. So maybe let's start with the first topic you addressed during the presentation, which is addressing this idea that fintech is dead, which has been a narrative for a while. You have a contrarian opinion, which for us is great because we're a fintech. Do you want to tell us a little bit about that?
Yeah, sure. It's not going to be news to anyone that obviously post-21, both the venture market and fintech market has been adjusting. And I think that was part of the narrative that has been floating on social media around, fintech being dead, when publicly listed companies had taken a massive hit on their valuation. They've been struggling to recover. And nowadays, you can see quite a bit of a normalization across the market when it comes to this. But the idea was there's still a lot of incumbent fintechs in the market that are generating north of 90 billion in annual revenues. And they have issues, the amount of time that you have to replace legacy technology just with change the bank functions rather than to run the bank functions is extraordinary. And part of the problem is these solutions have been built. They were cutting edge 20, 30, 40 years ago, and technology has evolved. But it's really hard to bring these solutions into the newest tech without rebuilding it from scratch. And hence, there is an opportunity to still go after different pillars of financial service opportunities with the new technologies. And hence, fintech is not dead. There's still opportunity.
Well, yeah, I know about legacy systems. I worked for many years at a very large global Swiss bank, won't name it, although I guess it's pretty easy to guess. And I understand that there's a lot of infrastructure struggles. So you see a big opportunity here still.
Yes, when you look at the adoption rate from fintechs that have gained momentum in the market, they can still go a lot further. I mean, even just if we look at this year's IPO announcements or even last year's, majority of the fintechs that have gained a huge scale were mostly on the B2C side rather than on the B2B side.
Okay.
And the B2B is significant because if we just take one pillar of opportunity, which is the asset management tech stack, you've got historical companies, I'm not going to name them, that have been built around the 80s and 90s. Some still run on COBOL. And
Exactly.
there's a reason why you don't do open heart surgery every day, but at a certain point in time when the business evolves and you have data silos and businesses that need to launch new products and capabilities have to really adjust to the new norm, there will be a point in time when the status quo doesn't work anymore. And we've seen a massive adoption of incumbents in new areas where they want to work with new companies because they understand that in order to stay competitive in the market and serve their clients better solutions, they have to improve on their tech stack. It's not a small exercise, of course, nobody's denying that, but I think that's where the opportunity still lies ahead. So the adoption rate of fintechs versus incumbents on the B2B side is still a way to go. And I'm talking neo banking engines, asset management tech stack replacements, infrastructure enablements, whether that's the individual payment rails, where we're talking about both the traditional finance as well as we could call it stablecoin era, and many, many more.
Core banking.
Core banking, yes.
Yeah. Okay. Great. So you mentioned tech, and that's going to bring us to our next subject, which is AI, because you can't talk about tech these days without mentioning AI. And I can imagine that not only is AI going to be a great opportunity, which I do want to talk to you about, but it must also be, or maybe I'm wrong, but I think of it as a driver for exactly this kind of infrastructure upgrades that people are going to have to do.
So, yeah, short of it, yes. I think let's explain first of all why people are getting excited. I think the rapid pace of adoption that we're seeing across Gen AI solutions is incredible. It's outpacing software to a magnitude, and hence the market potential is huge. And therefore, you're seeing a lot of VC investors throwing money at very talented technical founders to come and build new solutions. Now, that on its own is creating a bit of a complicated narrative because unless you're building an AI, I think the fundraising environment can be quite difficult. But then also on the AI side, if you don't scale in the same way as some of the best success stories, you might have challenges raising your next round, So starting with a very overhyped pre-seed or a seed round, then you have to start showing revenues and growth rates that match some of the top decile companies in order to justify the next overhyped valuation. And it's a snowball effect that can be detrimental very quickly unless the founders are able to execute on a extremely high growth rate. Now, there's plenty of examples where it worked out fantastically, and we've seen, huge successes of those companies, both on the revenue side as well as on the adoption side. But it bears in mind, like, what's the evolution? At what price do you come in? What is defensible? And those are, I think, topics that a lot of VC investors are keeping themselves busy with, and think about at which price point and how much risk they want to go into when they're underwriting these investment opportunities.
Eric, when we were preparing for this, you talked about also the possibility of AI helping in the creation of one-person unicorns, which is a tantalizing idea. Do you think we're going to see that?
I hope so. I mean, you can definitely already see smaller companies creating incredible amount of output on the revenue side with just having one founder operating in that way. The reason for it is effectively, if you are commercially sound and have a basic knowledge of technology, you can build with AI an incredible amount of army of
Mm-hmm.
agents with specific tasks that interlink with each other, um, and hence create the scale that you had no opportunity to do before, and the pace at which we're also able to create new products, new capabilities, new research, websites, even software solutions bundled with AI without the technical knowledge of actually doing the coding is incredible. So it's pace as well as democratization almost of the technical capabilities that normally you wouldn't have unless you went down to computer science background. So yeah, I think it's viable. I don't know whether we're gonna get to a $1 billion outcome with a single person. That sounds, you know, pretty incredible. But I think there's quite a few companies now pushing for that narrative.
So it occurs to me, though, that a company like that would probably, and correct me if I'm wrong, but would probably need less investment. You can do a lot more with less, right? So does this take away the investment opportunities in a sense?
So I think it's important to understand where do the costs lie, and with AI, it's
Mm-hmm.
usually the cloud costs rather than the actual cost for building the AI agents. Like, yes, there will be some costs in regards to building the agents, running the agents, but the real cost will be letting the agents run and think and hence do their work, which is the
Okay.
cloud cost. Um, and that's not for free. Now, in comparison to fintech platform companies with 80-90% gross margins, that is not necessarily possible with AI. You are running a much lower gross margin because you have that cloud cost problem. However, hence your fixed cost can be almost nothing in the example of a one person uh,
Mm-hmm. Mm-hmm.
company. So it is really thinking about the different cost line items that are driving the business model. And if you can get to a great amount of scale very quickly, you don't even have to raise large rounds to get there, and you can probably build up from smaller bases if you've hit the right ICP with the right product. So it's really exciting. And I think there's been an article that I just saw in the Forbes, which is effectively talking about the way VCs have to rethink the narrative on what's investable, what is a moat, which companies are here to stay. Because what we historically thought of as sticky enterprise software with good workflow, going after a customer that is getting a lot of value from this, suddenly with AI, a lot of it can happen in the background and you might not need those workflows. So
Mm-hmm.
food for thought.
And we touched on this at the beginning of the AI discussion, but I want to get back to it. We've seen some really wild valuations out there. How do you guys approach the valuation question in the AI space, and what do I need to be thinking about?
Oh, how long do we have?
It's open end,
um, we still approach valuations in the same way as in terms of understanding what the value of the company is today and what it's going to be in the future. Um, the challenge is to underwrite the risk of scaling, and hence you're seeing such a wide range of valuations of companies, because usually the biggest factor increasing the valuations tend to be the growth rates that companies
hmm
experience, because that is driving the scale. So on our end, we still we still go into Excel spreadsheets. We do our modeling. We try to understand the individual cost line items and how a more stable business could look like in terms of the profitability. Um, but the biggest question mark tends to be how big can this get? and how do you underwrite the time frame within which it can get to that scale based on historical data. Now, this narrative would not apply to someone who's a pre-seed investor, because there's nothing to analyze per se with regards to Excel. But for our stages where there's companies with 5 to 10 million revenues, certain expectations on growth, we can apply similar methodologies, but we have to think very differently around the forward, because you can see companies scaling at 10 times the pace of software companies.
Mm-hmm.
Yeah.
So it's a new world in a way, or
It is.
yeah.
Yeah. I mean, the counter argument is the long-term defensibility of certain value propositions and how others might pick up on it and replicate it. And hence, that tends to be the one argument from investment committees around, what is the true IP and the true defensibility of the company that you're looking into. Given the tools that we discussed about the one-man founder company that is able to scale to a great scale, because the Gen AIs are so capable. So if you have a person that is able to direct those tools in the right direction, suddenly you can create a lot of things that historically would have taken a lot of time.
So what's interesting is just today at lunch upstairs, I was talking with our head of AI, and he was saying how, like, a year ago, the talk was about training specialized models, right? For specialized use cases, healthcare or something similar, right? And that they're finding that doesn't work as well as they thought. That it's the big models that with context that are just actually doing better also in specialized situations. And that makes me think that it's really going to be just a few players at the end of the day.
I would decompose that into a handful of things. So there's large models and there's small models. And I think the large models are proving out to be incredibly good, and they're improving. And if you see the evolution of ChatGPT, Gemini, DeepSeek, and others, you can see that they also have for different use cases, different models, different costs associated running those. And hence not every model is well suited for every single exercise. I think your comment around training up models on a specific vertical, well, there might be that it's a lot more economical to train up a smaller model on a verticalized solution that doesn't require the really expensive O3 style reasoning on certain verticals. An AI agent can still run in a quick, efficient way. If you run, for example, certain deep research exercises on Gemini these days, it takes quite some time. So I think it's horses for courses, perhaps, but I wouldn't right now try and build a competitor to ChatGPT myself in terms of an investment from a VC point of view.
Sure. Yeah.
But would I be excited about verticalized AI solutions that tap into proprietary data sets with a strong understanding on a specific vertical? Probably yes. I can see quite a lot of applications there which are currently not even of interest for the large language models to go after, because it might not be their core focus point, and they're trying to improve the models rather than,
for example,
building out efficiency use cases across a specific segment by understanding how individuals within the organization are working to derive the same output that a human would. Example, how do you replace a VC investor? It's a combination of things. One is relationship making with early stage investors, co-investors, and investors afterwards. Then it's about doing the due diligence on the documents, the data that you have available, and kind of coming with and formulating investment thesis. and then doing the legal documentation and executing the deal before it's done. And then afterwards, it's effectively about trying to be helpful to the founder, or not interact with the founder if they don't want to. But there are slivers of the work that can be automated, augmented, improved with LLMs. And it is about combining different data sources, reasonings, and workflows that people can replicate nowadays with LLMs, but it is about building workflows and effectively your own AI agents to get to the same output, and an element of tweaking the models with the reasonings that you want them to deal with. The large language models are not necessarily always perfect for every single use case. I wouldn't, for example, these days run a comparables analysis to get exact numbers on an LLM because there's still hallucinations in the outputs. So horses for courses, but yeah, it will get there, and there might be components of the work that we do that will be 100% accurate by just using different solutions.
Okay, but that said, I'm curious, do you guys use AI in your valuations and in your work already? I'm assuming you do.
We do for research, and effectively to speed up data evaluation, data collection. We don't do it for valuation per se. The valuation, anything to do with Excel, the LLMs are not that great yet. So we can't replicate the financial modeling part of the exercise, which is quite lengthy for us. So I think once we get there, that'll be quite exciting because, yeah, a large proportion of the work deriving to a price point when it comes to the negotiations with founders is around the valuation exercise, which is driven by Excel.
Okay. You mean spreadsheets?
Yeah.
Yep. Okay, cool. All right. So another topic that you addressed at Acid Rush was which was another very hot topic these days, was stablecoins. So what are you guys seeing in the stablecoin space? What do you like? And where do you think we're going with that?
I think, first of all, it's exciting that we're seeing institutionalization of stablecoins and incumbents launching their own money market funds and cash products, as well as investment capabilities on stablecoins, which is creating a lot more comfort for people to effectively play around with them. I'll come back to the statement that Andreessen Horowitz made, which was effectively that stablecoins are the WhatsApp of money, because in a global world of payments and remittance, there's a lot of benefits that can be had from utilizing the blockchain technology and stablecoins, and having an element of tokenization of asset classes. So on the forward, I'm hoping that we'll see a lot more wealth management, asset management use cases that are going to be derived from this technology. And given the asset managers are already working on this, it's just a question of time. The interesting bits now these days are effectively how do you create the infrastructure layer that supports other stable coins, that creates a level of standardization and efficiency for others to interact with. Some players, besides driving cash products or treasury T-bill yields from stable coins, are now enabling, for example, private credit fund access via stable coins, which is effectively like a fund of fund wrapper effectively, or even access to individual private credit yielding investment opportunities into companies, or building out a public to private replication vehicle for synthetic exposures to public markets. So a lot more to come, I'm sure, but it's great that we're finally seeing a lot more momentum, because we started covering digital assets back in 2018, and I think it's fair to say back then it was all about blockchain, the application of blockchain in enterprises, and we know that has taken quite some time. Um, Back then, we've spoken to 76 players. I know the exact numbers, 76 players who were doing tokenization. Most of them started with the real estate use case. And back then it was very slow. I think there was a lot of real estate developers and real estate holders who wanted to explore the technology, but finding the demand supply curve and all the intermediaries that would have been willing to really drive this forward was really lacking behind. I think we're seeing now a lot more projects being opened up, traditional finance capabilities being launched around the tokenized efforts. So I'm hoping that a lot more will happen nowadays, but it is 6 years later. So, from a traditional venture investment point of view, it can be a misfire if you're waiting for 6 years on your realizations.
To what extent, and I'm assuming it's to a large extent, but to what extent can this stablecoin moment be related to the change of heart in the U.S. on the regulatory side?
I think that definitely helps, right? But there has been companies already at flight before that, so I don't think it's suddenly Trump is in the seat and now we're gonna go full throttle on stablecoins, because certain incumbents move at different pace. So they must have been working on it for quite some time before it came out. So that narrative helps in terms of getting people excited about it, pushing through funding and visibility, but it's in flight from before.
You just mentioned before private credit and the private credit markets. And at Acid Rush, you brought in some incredible numbers about the growth of these markets. So you want to tell us a bit about that?
Yeah. I mean, I'm not going to lie when I say that most people are probably scared of private credit for good and bad reasons. But we're starting to see some exciting opportunities. Usually having a bit of a contrarian view is interesting to follow through. But the interesting stats is effectively the growth of the private credit market as its own. I mean, it started post GFC when the banks had to pull back from the market given the toughness that they had, the regulatory pressures, and consolidating their books, which left a vacuum of demand for credit from SMBs that were not able to get it. And effectively, the private credit funds started out generating attractive yields to service this market. And nowadays you see vehicles and the tens of billions being launched by the behemoths like Ares and Blackstone and others that are servicing this market primarily in the US, but also in Europe. I mean, the expectation is that the market, depending on which forecast you believe in, whether that's BlackRock, Preqin, McKinsey, or other studies that were done, it's expected to grow from current 1.5 trillion to 2.6 to 3.5 in the next 4 years, right? So that's incredible. The other stat, which is quite crazy, is that the whole market was worth 200 billion as part of the non-lenders, so non-banks, back in 2000. So the market has come a long way, and obviously doubling or even more within the next 4 years is still testament to the fact that there's massive demand.
Yes, I mean, we're seeing that as well here. And obviously at Gen 2, our narrative is that there's also room here for smaller players, right? Because we have the securitization platform, and we think via an AMC or these kind of things, you can, and we have clients who already do this, right? It becomes much easier to package private investments of all kinds and all non-bankable assets into bankable security. So do you think there's room for the smaller players as well?
100%. Not just that, but also if you think about the retail investors, nowadays, as a retail investor, it's really difficult to buy private credit unless you buy the US BDC companies. So if you have assetized funds that people can just buy via their brokerage, then suddenly you can give them exposure to this asset class. So I know there's an LTIF 2.0 regulation that's supposed to open things up, but we should definitely do more, because I know that there's demand for the asset class. And at the same time, everyone keeps on quoting the massive SMB credit gap in Europe. So I always just hear about some brand new fund raising $1 billion opportunity for private credit distribution. So there's still new funds being opened up and going after this market. So I'm sure there is. What will be the differentiator there is most likely having an understanding of a specific market that they can underwrite better than the large players.
So Erik, another topic you brought up at Acid Rush, which made me smile, was the whole ESG discussion, because there's this narrative out there. In fact, on the podcast that we dropped today, we're all talking about carbon assets and this whole idea that ESG is dead and climate, nobody, it's not investable anymore, etc. And my guest today had a very contrarian view against that, and I believe you do as well.
Well, I'm a bit biased because I've been researching this space for 4 years, and we've done 3 investments in this space as well. But at the same time, it's interesting anecdotes that we're getting from them in terms of what's actually happening in the market. So the biggest revelation is that ESG is not going anywhere per se, but people are rebranding, and primarily because of the narrative around policy coming from the States. So, these days, rather than talking about ESG and sustainability, people talk about supply chain management and compliance-driven measures, or ROI, almost from a procurement point of view. So it's an important reminder also for companies operating in this space that suddenly they have to push harder on the CFO who holds the budget, rather than just on the chief sustainability officer in large organizations. But a few topics there effectively mean that, especially for anyone operating in Europe, consumers care, and hence that topic is not disappearing. You can see a bit of a relaxation around regulation. The omnibus regulation got pushed out, which has an impact. Carbon markets, whether that's voluntary or compliance, is also quite a big topic, right? So there were articles around fraudulent behaviors driven around the voluntary carbon markets, which didn't help the industry. And we had to go and do a proper review of which projects are actually delivering the credits that people deem fit. Actually, one of our companies, Silvera, is in the forefront of that, making sure that the projects that you buy into are actually the ones, and that someone's not going to cut down the trees, because then you are in trouble effectively. But yeah, it's a new market that also requires more institutionalization. And the CFOs still hold the budgets. The CDR volumes keep on increasing. And given the narrative I've been hearing from some of our founders around the relabeling and focusing on ROI, I don't think it's going anywhere. It's just almost like a maturization of the industry.
Yeah, well, that's interesting, because I remember working on these topics 5 and 10 years ago, and one of the narratives on ESG was, look, it's not just good for the planet; it's good business, right? Especially on the governance topics and stuff like that. So this seems to be that angle on it.
100%. I mean, if you don't have good governance, then you don't have a business. So,
yeah.
if we go back to the acronym of ESG, you could argue whether E will deliver you more revenue or better cost of operation. I think the devil's in the detail on that one. The S actually creates a lot more stickiness with employees and creates purpose, which can create value on its own. But if you don't have G, then you have a big problem, and you have you might be risking you don't have a business. So, and that's a core pillar of the ESG component. So, 100%.
Great, super. So Erik, last question I'm going to ask you, and then we can see if there's anything else you want to talk about. But that I'm going to ask you is, and I guess I have an interest in this myself as a potential investor, is where do you see big value going forward? What's your take on the interesting opportunities out there today?
Personally speaking, I have been playing around with AI for quite some time and use it on a day-to-day basis. And there's been quite a few moments where I was pretty impressed with the output that I'm getting, and it's just improving on a week by week basis. So I'm super
Yeah.
excited to see the evolution of that, and less from a investment point of view, that having my VC hat on, and just purely from a human, to see the implications of how we live and how quickly I can source information. I personally use the Gemini a lot for deep research, and find it fascinating how much I learn as well by using these tools, and how I'm accelerating my own research. So almost ignoring the job side of things, just as a human, the access to information and the scale at which I'm able to get it is fascinating. I think that's going to change how the future generations are going to work. Bank of America has done a very interesting analysis on the future of jobs. I think it's definitely
Yeah.
worth reading, because the way my daughter will be engaging with the workforce is probably very different than what we're doing today. So that gives also some food for thought around where does the value accrue, and how to engage with that, how to create defensible skill sets, and some big questions that I think any investor that is thinking about the future needs to solve for.
Okay, well, let me ask you in that case. Can I ask most people when I talk AI? I mean, I have a 15-year-old and an 11-year-old at home as well. I don't know what to tell them in terms of how to prepare for the future, because I have no idea. Do you not worry at all
Of course,
about job
yeah,
replacement, about AI Armageddons and that kind of thing?
definitely worry about it. The way I would decompose it is, uh, there's AI safety, and I think there's an element of like, okay, how do we help our future generations learn with what they have, and how to create the right skill sets. Um, and the answer is probably not going to be the same one for each individual. Um, I would say that Gen AI is democratizing intelligence to a great extent. Um, so perhaps, really focusing on the human to human interactions, the EQ components will be something that will stand out. But at the same time, these days, the people who are really using AI in the best possible way are the ones that have a commercial mindset and are able to construct the pathways to solving problems by using the toolkit in the right way. So we're not there yet. Maybe we'll get there in the future. But today, you still have to be the one driving the outcome and designing the way that you want the AI to
Mm-hmm.
solve
Mm-hmm.
problems for you.
Mm-hmm.
And that also comes with experience. And hence your question on what you tell a teenager who doesn't have that experience, and how can you get there. I saw some shocking stats with the US unemployment rate for graduates is the highest it's ever been.
I saw that. Yeah.
And it points towards, few hiring jobs. I don't think I wouldn't paint a gloomy outlook, because society has always found a way on
Yeah.
adopting to the market. But we need to figure out, it's a true revolution that we haven't been exposed to, and it has only started.
Yeah. I mean, just maybe quick on that, and I'm getting into personalized here, but I mean, we're here at Gen 2. My boss wants to build a hands-free marketing department using AI, which makes a lot of sense. That's what we all want to do. And I've been working with it extensively since the last year and a half, and I've had quite a lot of success, I think. And my, I'm enhanced and my outputs are great. But I can tell that that's only working because I have these 20, 25 years of experience under my belt, right? I can tell the pitfalls as well, right? And I know, because you've just been and you've seen that. And I think to myself, I may be an entry-level communications person or an entry-level marketing person's worst nightmare, right? Because that's who, at least in theory, I'm replacing. On the other hand, like you said, the young generations come up with this stuff and they figure something out that we never thought of. So it's hard to tell.
And they're playing with those tools a lot more. So they're also being a lot more creative, and the barriers for them to create new companies are also much lower. So we were by surprise, maybe it will create a massive rush of entrepreneurs before the age of 20, because they will have all the tools available to, compete in new areas that we haven't considered before.
That's a great thought. I like that one. Why don't we leave it at that? That's a hopeful one. And Erik, thank you very, very much. It's been a great conversation, and we're really glad to have you on the show.
Thank you, Tom. I appreciate it. And thanks for all the good questions.
This is the Assetizer Podcast.